Imagine a president trying to lower your mortgage payment with a single post online. Not a speech, not a bill, a post. This week, Donald Trump announced he had ordered the purchase of $200 billion in mortgage bonds. The goal was simple: push interest rates down, make homes affordable again. It sounds bold. It sounds decisive. It sounds like action in a country where owning a home is slipping out of reach. But economics does not move by command. Markets do not respond to intention alone. And history tells us that when governments step directly into housing finance, the consequences rarely stop where they begin. So the real question is not whether mortgage rates could fall. It is whether this move treats the disease or only masks the symptoms. If you want to understand how power, policy, and markets collide in moments like this, stay with me. This story is bigger than housing, because before we debate solutions, we have to understand the problem itself. At the heart of this moment is a simple but dangerous misunderstanding. Many Americans believe high mortgage rates are the cause of the housing crisis. They are not. They are a symptom. Housing affordability has collapsed because three forces collided at once. Interest rates surged after years of cheap money. Home supply froze as millions of owners locked in ultra-low pandemic mortgages, and new construction never caught up with population growth. In that environment, lowering rates feels like the obvious fix. Cheaper borrowing means cheaper homes, at least in theory, but housing is not a light switch. Lower rates do not automatically create new homes. They do not free trapped inventory, and they do not undo years of underbuilding. This is why Trump's announcement matters. Not because it is guaranteed to fail, but because it targets the price of money rather than the structure of the market. To see why that distinction matters, we need to look backward. Because America has tried this before. For decades, the American housing market has moved in cycles. And each cycle leaves behind a lesson politicians tend to forget. After the 2008 financial crisis, the Federal Reserve stepped in aggressively. It bought massive quantities of mortgage-backed securities. The goal was stabilization, prevent collapse, restore confidence. It worked at a cost. Cheap money flooded the system. Mortgage rates fell to historic lows. Home prices climbed steadily, then rapidly. Then came the pandemic. The Fed went even further. Hundreds of billions of dollars in mortgage bonds were purchased. Rates dropped below 3%. Demand exploded overnight, but supply did not. Construction lagged. Zoning laws stayed tight. Labor and material costs surged. By the time inflation arrived, the imbalance was locked in. Millions of homeowners were frozen in place by ultra-low mortgages. Moving meant doubling their interest rate. So they stayed. Today, America is short by roughly 4 million homes. Inventory is near its lowest level since the last housing crash. This is the backdrop Trump is stepping into, and it sets the stage for the first shock. Then came the announcement, and with it, the first real tremor. Donald Trump did not speak in cautious economic language. He spoke in absolutes: $200 billion, immediate action, lower rates, lower payments. He pointed directly to Fannie Mae and Freddie Mac, two government-controlled giants, entities that sit quietly beneath the American housing market, touching nearly every mortgage written in this country. Trump argued they were sitting on a fortune. Enough cash, he said, to act now. No waiting, no debate. But this was not the Federal Reserve. This was not a central bank acting through established monetary channels. This was a political directive aimed straight at the mortgage market. And markets noticed, because when political power signals intervention, uncertainty rises before relief arrives. Who exactly would buy the bonds? Under what authority? With what limits? And most importantly, what happens next if the first move fails? The housing system depends on confidence, in rates, in rules, in restraint, This move challenged all three at once, and beneath the promise of cheaper homes, a deeper risk began to surface. What sits beneath this moment is a mechanism few people ever see, but it quietly determines whether housing becomes affordable or dangerously distorted. Mortgage bonds are not magic levers. They are confidence instruments. They work only when investors believe rules will not change overnight. When a buyer enters that market at massive scale, yields can fall. Rates can follow, but only if investors trust the move is limited, legal, and temporary. The Federal Reserve succeeds here because it is boring, predictable, detached from electoral pressure. Political intervention is different. It introduces uncertainty about duration and motive. If markets suspect bond buying is driven by politics rather than stability, risk premiums rise. And higher risk premiums mean higher rates, not lower ones. There is another constraint. Mortgage rates are not set by bond purchases alone. They reflect inflation expectations, government debt, and long-term confidence in policy discipline. Even if $200 billion enters the market, it collides with a deeper problem. Too few homes, too many buyers, frozen inventory. Without new supply, lower rates can even backfire. Demand surges, prices rise, affordability worsens. This is the paradox at the center of Trump's strategy. It aims to relieve pressure by pulling a lever that no longer controls the system. And when pressure remains, systems tend to crack elsewhere. Then the second shock begins to take shape. And this one is quieter but more dangerous. Lower rates do not just help buyers. They also revive speculation. Investors return. Cash competes with families. In a market already short millions of homes, even a small drop in rates can ignite bidding wars. Not in luxury neighborhoods, but in ordinary cities, starter homes, places where affordability is already fragile. Prices rise faster than wages. Down payments stretch further out of reach. The very people this policy is meant to help feel squeezed again. And there is another risk. If Fannie and Freddie absorb massive quantities of mortgage bonds, exposure concentrates. Losses, if they come, are no longer private. They land on the public balance sheet. America has seen this movie before. When housing finance becomes a political tool, incentives blur. Short-term relief competes with long-term stability. The danger is not an immediate crash. It is something subtler, a slow rebuilding of the same imbalances that once broke the system. This is the moment where good intentions meet structural reality and where ordinary Americans feel the consequences first. Now shift the lens away from policy and markets and bring it back to you. If you are trying to buy a home today, this debate is not theoretical. It is deeply personal. You watch rates, you refresh listings, you run the numbers again and again. A small drop in mortgage rates feels like hope. It feels like relief is finally coming. But here is the cruel reality. If rates fall without new homes being built, you do not win. You compete harder. More buyers rush in. Prices adjust upward. Sellers gain leverage. And the monthly payment you hoped would shrink quietly reinflates. For renters, the story is no better. Higher home prices push demand back into rentals. Rents stay high. Savings fall behind. This is why housing crises linger. They trap people in place, delay families, reshape life decisions, and this is where leadership matters most. Because symbolic action feels powerful, but structural change is what actually changes lives. If you care about housing, you cannot stop at interest rates. You have to confront supply, zoning, construction, time. And once America's housing problem reaches that scale, it no longer stays domestic. Housing may feel like a domestic issue. It is not. America's mortgage market is deeply tied to global capital flows. Foreign investors hold US debt. global funds price American mortgage bonds into portfolios worldwide. When the United States signals political intervention in housing finance, markets abroad pay attention. Because uncertainty in U.S. policy does not stay contained. If investors demand higher premiums to compensate for political risk, borrowing costs rise elsewhere. Not just for homes, for governments, for corporations, for emerging markets already under pressure. There is also the currency effect. Large-scale bond purchases influence capital movement. They affect the dollar. They shape inflation expectations beyond U.S. borders. And then there is precedent. If Washington treats housing finance as an executive lever, other governments take notes. Some follow, others push further. This is how localized interventions ripple outward. Through markets, through trust, through expectations, housing becomes a signal, not of affordability, but of how power is exercised in an interconnected financial system. And when signals change, the future rarely unfolds in just one way. What happens next depends on which forces win: policy, markets, or reality. In the best case, this move becomes a signal, not a substitute. Bond purchases calm markets briefly. Rates ease modestly. And political pressure finally shifts toward construction, zoning reform, and supply expansion. Affordability improves slowly, not dramatically, but sustainably. In the middle scenario, the system muddles through. Rates dip, then stabilize. Prices adjust upward just enough to cancel the gains. Housing remains expensive, but not catastrophic. The crisis becomes permanent background noise, managed, never solved. Then there is the worst case. Markets doubt the limits of intervention. Risk premiums rise. Bond yields climb instead of falling. Housing costs stay high while public exposure grows. Political control replaces institutional credibility. In that world, trust erodes quietly. Not overnight, but step by step. And once confidence breaks, it is expensive to rebuild. Housing is not just shelter. It is leverage, debt, belief in the future. Which path America takes will not be decided by a single bond purchase. It will be decided by whether leaders confront the system as it is, or try to command it as they wish it were. And that brings us to the final question. This announcement was never really about mortgage bonds. It was about power. The power to signal control in a system that feels out of control. The power to promise relief in a country desperate for it. And the temptation to believe that scale alone can solve structural problems. $200 billion sounds enormous, but housing is not a liquidity problem. It is a supply problem layered on decades of policy choices. Lower rates may offer momentary relief, but they cannot manufacture homes. They cannot rewrite zoning laws. They cannot compress years of construction into months. So the real test is not whether mortgage payments fall. It is whether this moment forces a deeper reckoning. Because if America continues to treat housing as a financial puzzle rather than a physical one, each intervention will feel bold and change very little. If you want to understand where this crisis goes next, this is only the beginning. The next moves will matter far more than the announcement itself, and I'll be here to walk you through them.